Today's session is based around the growth trap, specific to asset finance. When winning new money costs you money. So to kick things off, really, winning work doesn't mean having cash. Essentially, winning work for most businesses, for me, it should be exciting. It shouldn't be instantly having barriers or pressures that could potentially stunt the growth when they've just landed potentially a really nice contract. Now, most businesses do ever face the same trap, the instant cash squeeze when purchasing new equipment to try and fulfill the work of that exciting new contract that they have just got, or they've worked really hard to finally land. This obviously isn't to mention the day-to-day pressures of additional costs within the business, materials, fuel, payroll. So this really backs up the point that for businesses, cash is king. So when purchasing a new asset for that newly won contract, it's often paid upfront, which is great if you've got the cash to utilize that. However, that isn't necessarily what you have to do. What I wanted to do is go through a little bit of the trade-off. So Byron, are you all right
Yeah,
to
absolutely.
help me with this?
Yeah, so there's going to be some terminology that you're going to see from the UK, and I'll make a little bit of a quick translation to our North American friends here. But really,
Mhm.
when we're looking at buying versus financing, there really is a big trade-off here, right? So one thing is the opportunity cost in terms of not being able to take on this job, but then when you do want to take on these jobs, there is going to be that requirement of, maybe getting a piece of equipment or a piece of software for some of our asset light type of friends. So really, there's the two options that you're really gonna be looking at is going to be how much cash, or when you take this asset, what is the implication against your balance sheet and your cash, right? So the first thing is going to be if you were to buy it, say you have cash in the bank, you're going to take on the ownership of this equipment. You're essentially going to shell out this, for example, $120,000 to purchase, a piece of equipment to help manage a contract. So that hit is going to actually impact your direct bank statements. It's going to impact your ability to maybe pay off some of your suppliers, to pay off your payroll, and it may just impact your overall day-to-day operation. In the cases where you did have a large enough reserve, that's amazing. But this is just one way that it just highlights the fact that there are going to be consequences to buying things outright. The alternative, and this is kind of what we're preaching towards, is going to be financing it. So this is going to be something where you don't necessarily have to put any cash output. Really what you're doing is we're going to finance that and spread the costs over a foreseeable future, so maybe a 3 to 4 year term, and that way you can protect that cash in your bank account so you can use that towards your day-to-day operation, use that towards growing projects, taking on more work, because that's really what it comes down to, right? Is you have a project, you want to be able to support it. Does it make sense to use the capital you have currently, or will that stunt your growth or stunt your progress with other jobs and other opportunities that are on the table? So you want to factor that in when you are making these ultimate decisions. So there's two different, I guess, considerations to add for. So finance, the reason why you want to finance is to preserve your working capital. It helps match your repayments to revenue. So, I'm sure you've seen a lot of situations where you've had a contract you're going to pay, you're a progress bill, you're not going to get paid right away. But with matching the actual payments to your revenue cycle, it'll make it a little bit easier from a cash flow perspective without having to bridge that gap through external financing. It also helps you enable concurrent projects. So like I said, you're going to have the ability to support other projects, support other, I guess, things you want to work on within the company. And this is a good way for you to preserve that. And that's through financing. And it also keeps credit lines open. So it's something that's very common in North America as well as the UK, in that the more trade lines you have, the more trade lines you have current is going to build your commercial credit history. And that's very helpful when it comes to getting additional bank financing, when it comes to getting additional capital, especially when you are looking to grow. So the more you have, the more current you are, and the ability to support it is going to be very helpful in the long run. And then some considerations, there is going to be a slightly higher cost. So in order to borrow money, there is typically an interest cost that gets associated with it. So that is something to factor in, but really it's, time value is money now versus money later, right? And then there's going to be, just going through a normal type of credit approval. So it requires lender approval, and it also requires a monthly commitment throughout the term. So that is something you're going to have to budget for. You want to make sure that it's allocated in your cash flow forecast, and you have the ability to support that over the life of this loan. Cool. And then just to kind of dive into a little more of the theory behind all this, and it's just more so between hire purchase and finance lease. So hire purchase and for my US and Canadian friends, that's the equivalent to equipment loan or to a capital lease, and a finance lease is the equivalent to an operating lease. So there's two different ways that we can approach this. So hire purchase means that you're essentially going to own the asset. So you're borrowing money, but you're going to own this asset and it's going to be reflected on your balance sheet. So that means you're going to have access to writing off the depreciation or amortization. You're going to be able to also write off the lease payments, and it's going to lower your taxable income. So that's a benefit overall, and I'll touch on that in the next slide. But that's really what the hire purchase is you're going to actually own it. It's going to be on your balance sheet. You're going to retain it. You're going to have to manage a lot of the expenses, the maintenance, and whatnot. The alternative is a finance lease. So this is where you see a lot of like trucks and vehicles, and where there's a lot more deterioration is going to happen depending on how much use goes into it. The lender's still going to own the asset. It's not going to show up on your balance sheet. It's actually just going to show up as a lease payment or a rent payment essentially on your income statement. So that's just going to be a different way to approach it. We tend to kind of use them in different ways. And really for a finance lease, it's really good for things that you don't expect yourself to carry for a long period of time. You want to have you have this project, you only want to freeze it for 2 years. Great. Now you can pass it off and the lender can kind of manage it with you having to dispose of it or sell it. So it really just depends on what your use case is going to be here, the type of equipment, the useful life, and is there going to be a resale value in the back end of this, right? You want to understand your overall cash flow and your overall kind of implications on the balance sheet. So that's why you want to decide between a capital lease or a hire purchase versus a operating lease or finance lease. So with an operating lease, and just to kind of reiterate, so it is essentially like a rental style agreement. So you just kind of get in there, the actual lender would control the asset, and you'd be paying monthly payments. Like I said, so great for vehicles, great for IT, software, things like that, where you're not necessarily going to actually retain the physical asset, and you're not going to see a lot of value for holding it. And then the alternative is, for just to decide on which one to choose is. So for a equipment loan or a hire purchase, it's really if you want to own that asset long term. Think like yellow steel, a crane. Like this is going to really inflate your balance sheet, increase the valuation of your overall company, and you're going to see that ROI and that return on assets later on down the road. For a finance lease or an operating lease, it's really just more for a tax efficiency and just for flexibility. You're only going to need it for a couple of years. You're only going to need it for this one specific project, and then carrying that's going to really be more burdensome because of the storage costs and all the other soft costs associated with it. So at that point in time, it may make sense to kind of bring it back to the lender and have them utilize it and have them dispose of the actual. You can always upgrade as well in certain cases where usually at the end of a lease term, they'll allow you the option to buy it out. So it's not to say you have to start with one or the other. You could start with one, and then there could be that opportunity to do a full buyout towards the end and actually retain that ownership after the term is done. Cool. And just to kind of dive into this, I know I touched on this is previously is more so the tax and the flexibility. So there are obviously tax incentives. And I think when we talk to a lot of entrepreneurs and a lot of advisors, one of the biggest things is, I don't want to pay taxes. I want to reduce that my taxable income, and I want to be able to support. Thankfully, with equipment lending and asset-based lending, even software lending, it doesn't necessarily rely too much on the debt service coverage of the business. So, we see a lot of businesses, but don't necessarily have the profitability. What we're seeing is more so is the asset strong? Do you have the commercial credit and to actually support a purchase and be able to utilize this for your business? And do you see that benefit? Can we build a case around, how much revenue this is going to increase or how much your efficiency is going to come out of this? So there are different tax advantages. So with lease payments, they're going to be 100% deductible against taxable profit. So it's going to reduce that overall tax burden towards the end. With a hire purchase or an equipment loan, there's going to be some capital allowances, especially including the annual investment allowance, and that is also spread across payments rather than one large hit. In the US and in Canada, there's going to be depreciation, amortization. There's going to be a couple other types of incentives towards this. And then at the end of term options with the hire purchase or an equipment loan, the asset's going to be yours. It's going to be in your balance sheet. It's going to be written down. You're going to have that asset in your property, plant, and equipment section, and that way it's going to be able to stay there forever until you dispose of the asset. And then with the finance lease, you'll be able to either sell it, extend it, or upgrade to a newer kit, as well as with an operating lease. And then, so there's a couple of things that matter. So the first benefit being, a 19% corporation tax saving on lease payments puts real money back in the business. So that's a real thing, right? I mean, we're recognizing our whole premise here is how do we protect cash flow for a business? On one hand, you're going to be able to protect the cash in your bank account that you don't require to put down to purchase equipment. But on the other hand, it's really, you actually get real-time savings by way of reducing your tax bill. That's a huge benefit, and a lot of accountants strive for that for their clients. And that's just something to consider when you are having these discussions. And I would also discuss with your accountant the best time to purchase. And there are some other times that, there are going to be more forgiving than others. The next benefit is with capital allowances on hire purchases, it can offset your entire tax bill in 1 year via AIA. Similar to kind of amortization depreciation, depending on the way you structure this, is that double declining method would actually reduce your overall taxable income and ultimately get more money back in your pocket. And then lastly, flexible end of term means that you never get stuck with aging or obsolete equipment. Like how often do you see you see yourself or competitors buying a piece of equipment, and then 2 years later they basically remove all the software upgrades, remove all the ability to actually maintain it, and now you're stuck with the old piece of equipment with needing newer parts. That's a scenario we want to avoid, and using these types of solutions actually help you benefit against that and are able to stay current, stay with the time, especially with how fast tech's been progressing. It's a good way for you to also capitalize on future advancements as well without being stuck on the balance sheet.
So yeah, let's go through some numbers. Now, this is a example, which as you can see there, so a construction firm wins a 12-month groundworks contract worth 480,000. Instantly, they're going to need 2 excavators and some specialist kit to fulfill that groundworks contract. So instantly, there's a demand for multiple new assets. Now, see, purchasing the equipment day one has the potential to use up all of that cash, potentially putting themselves in what the overdraft position here is of a negative 20,000. This is gradually going to also incur payroll strains, limit maybe the contracts that they've got ongoing or want to take on in the future months. Are all potential outcomes from purchasing the equipment needed upfront and leaving you in that hole straight away. So this is where an asset finance agreement can take that cash strain away. So obviously option B, taking out a hire purchase agreement for the total cost, spreads that cost out monthly, in this case over 48 months, to roughly 3,000 quid. Having it monthly, for the next 4 years is a really manageable way versus the monthly income on taking on that contract. Now, it may be that revenue straight away has come in of part payment of saying yes and landing the contract, or it's monthly coming in with the invoices that should be putting yourself in a profitable position rather than having to chase trying to get that bank balance back to where it was of that initial dent when you bought the equipment. Of course, there is that finance premium to take into consideration. You are going to be paying slightly more than the actual cost of the asset. However, the extra revenue unlocks on that potential second, third, fourth contract is definitely worth noting from choosing option B and taking out a finance agreement.
Yeah,
So,
one other sorry, before you just want to jump in real quick, just to kind of highlight one other thing, because I know the last two scenarios were more so reliant on taking on a contract and growing. Another scenario that we do see come across quite a bit is investing in assets or upgrading equipment for operational efficiency. So that's going to help more on the bottom line versus the top line. It's not something that you're going to it's not typically a conversation you're going to have when it comes to how much revenue am I going to produce, and is this going to actually stunt my growth? But what happens is you're not really going to see that ROI or that return on assets till a lot later down the road. So that's why financing for upgrading to more energy efficient equipment or even software, right? A lot of these will have very distinct and large upfront costs that could really impact the business, but ultimately you're trying to save yourself money over the long run. So sometimes financing that over 4 or 5 years, spreading out those payments will help you see that profitability increase over that 10-year or 15-year horizon that you are forecasting for. So just something to consider, not necessarily growth related, but more so growing the bottom line versus the top line. So just on the flip side there.
sure, no, but I appreciate that. And I mean, also, your decision doesn't have to be made at the point of purchasing the assets, whether you want to, take out a finance agreement. It might be that the you got the right deal at that time, or it had to be bought within a certain time frame, and you then, a couple of months into utilizing those assets that you then could do with the money back in the bank account. So we can go down the route of refinancing those assets or on a sale and hire purchase back, which if you pay for those assets, you've then got 3 months with most lenders where you can then get that full cost back. Or if it's even further down the line than that, then you can refinance them at a value that the lender gives. So if you haven't made that decision right there at the right time, or it might have been the commercial decision, then you can go back and revisit that, but potentially putting some more cash back in the bank by utilizing a refinance method as well. So
That's a
moving
very
on.
common, I guess, scenario that we come across in North America, where a business is looking to buy a piece of equipment from international suppliers. And the
Absolutely, yeah.
unfortunate thing is that financing doesn't necessarily stretch across to pay out those. So what we see a lot of times is businesses will just pay it out of cash, and then what happens is once it ends up on North American soil, then it becomes financeable through one of our lenders. So it's just a way that we can look at it. Sometimes it's an overlooked thought because they look at the bank and say, "Hey, we can't get financing now. We're just going to pay out cash." But then really there are products and there are options available on the back end, and that can be anytime within the span of 12 months of arrival. So there is a quite a large window, and it's just something that I implore all business owners and advisors to have those conversations with their accounting and understanding the books there.
Yeah, 100% agree with that. Absolutely. So yeah, comparing options without wasting time. Now, as I mentioned previously, we work with hundreds of lenders and have access to multiple areas of lending. So I sort of want to share a little bit about what our lenders assess when they are presented, with the deal. So typically the asset will be their first factor that they look at for obvious reasons, because that's where they're going to, be taking their security. Different lenders will have different criteria. However, typically the newer assets gives you access to better rates. Another area that will give you access to them better rates is the affordability within the business. So that's sort of the second thing that they will look at. So the likes of the revenue, the trading history, the cash in the bank, looking at the financials to essentially determine the affordability of what you're looking to try and buy. This will then, hopefully issue an approval, which a lot of the approvals last, 3 or so months, or if it's on a credit line, that credit line can just keep being extended for 6 to 12 months. So if you've got something coming up, but it isn't, you need it right now, you can get well ahead of the game, get the approval done with our lenders, and then we just hold out and wait for that for the right moment, and then you've got the confidence that you've got everything back sorted and in place, ready to go. So when given a quotation, a good assessment is to, sort of look at the total amount repayable. Obviously, of course, you want to know the cost that is potentially incurring. Also, there is lots of different things that you can add to an agreement, whether it might be a balloon or a residual payment. That could potentially bring your monthly repayments during the term down. Does obviously mean that you have a end figure that will need to be paid. However, we've seen in instances that can also be refinanced as well. So you're just extending the duration of having that asset, and naturally the early repayment penalties is something to obviously also be aware of as well.
Cool. And just to kind of bring this back to North America in terms of our overall funding. So one of the biggest impacts or the biggest considerations is actually on commercial credit. So that's why going back to one of our previous lines with build it more, having more trade lines is very helpful. So having a high commercial credit can actually get you approvals without even having to submit any formal documents. We can get approvals, up to 250,000 on equipment with all we need is an application form and the actual quote itself. So very quick, very efficient process. And it doesn't rely anything on the personal side. As you start to get into, the larger transactions or younger businesses with maybe a bit weaker commercial credit, that's when we start to look at personal information, personal financials, and get a sense. Not to say we also can't do startups, like that is something that's within the scope as well. So yeah, the North American space is quite vast, and they do have quite a few different opportunities there. We just need to understand the actual piece of equipment, what's the resaleability, what's your credit profile, and then from there we'd have to understand, do you have the ability to make these repayments? Even if maybe historically you weren't able to, that's what we always want to build a case. Look at a cash flow forecast, look at, what is this job going to help you do? And that's how we're going to be able to build a case overall. And ultimately we can tie this back together and get a successful approval. So you to get some cash for this purchase and ultimately keeping some in your pocket.
So what to do next, really? Nice and simple, really. There's 3 steps process with us here. Step 1 is nice and simple. We'll go through the credit searches. They can be done nice and quickly, real easy thing for us to do. Step 2, compare specialist lenders across all of the lenders that we've got. As I said, we've got access to so many different lenders that have different criteria, and we'll look at different assets. It doesn't have to be the sort of big hard assets that we've gone through in the slideshow, but the nature of the way of asset finance is going is if it's tangible, if it's got a serial number, or if it's for business purpose, typically you can fund it. There's been some weird and wacky things that have been funded, but if you need it for your business to help grow, lenders will look at that and definitely look to fund it. And then step 3, align a repayment start with a first project drawdown, so we can get all of this sorted exactly from the get-go, and you're stress-free. It's all sorted from that front. So on screen now, you should be able to see a couple of QR codes for you to access funding options, check out Swoop, back up all the things that we have just gone through. So I'll leave this on the screen now, and with the short amount of time that we've got left, feel free to pop some questions in the Q&A box, and myself and Byron will try to answer them as many as we can.
I just saw a question from Matthew. So minimum deal size, no, not necessarily in North American market. We've got options that can go very small, like even like 10 to 15K. So there is the opportunity. We just have to understand the credit profile of who the borrower is. So yeah, there's really no minimum and there is no maximum. We've got lenders, and that's kind of the benefit of working with the marketplace like ourselves, is that we do have a vast and broad network of different types of lending products. Cool. Hey Jonathan, thanks for tuning in. When it comes to for how long it usually takes to get funds from lenders, so in the North American market, we've seen it move very quickly. We've seen approvals get approved. Pre-approvals get done within about let's say 3 to 6 hours, and with the view that we can get these funded within 48. As long as we got the right quote, we've got a vendor that's reliable and something that we can actually, or our lenders can actually reach out to, we can get them done very, very fast. So I'd say within 24 to 48 hours is kind of on the speedier side for us.
Yeah, I back that up absolutely. I do like to say, if you can, have the first conversation with us at the start of the week, you should have the assets that you need for whatever you need them for by the end of the week. It depends times of year, do take into consideration and have some potential impact, but yeah, absolutely, they are just as quick as what Byron said. That's pretty much it. So thanks for tuning in, and yeah, catch you all soon.